Good day, fellow investors.
September value investing quadrant update. We have 5 stocks to buy. Used to be 10, but most of the stocks went up. What can I do? Let me first explain the quadrant. This is the June version. We have reward on the x-axis from low to high and risk on the y from low at the top to high at the lower. So the best investment will be low risk, high reward here. The worst investment will be low reward and high risk here. That is how I structure this value investing quadrant. I try to have a time horizon of 10 years and I base it on the intrinsic value calculations that you can find on the freely shared intrinsic value comparative table in the link in the description below on my free course. I'll put timestamps, so you might want to jump to the things that are interesting for you. We'll cover all the stocks represented here, the risk and reward, touch on that, what can you expect from that perspective, how sure can you be that it will be good for your long-term wealth. S&P 500, well, let me go to Charlie Munger. One of his best quotes is, "Don't do cocaine, don't race trains, and avoid AIDS situations." At this moment in time, I believe that the S&P 500 could be close to an AIDS situation for your money, your portfolio. I'm not joking, but if we just look at valuations, the P ratio is 29, that implies a 3.3% return, compared to the mean of around 15, which means that the price is twice the historical average, half the historical return at best will be the result. This is simply maths. Because if we take 3% yield, we deduct 1% from all the crazy buybacks everyone is doing, except Warren Buffett, as we discussed yesterday, add 2% of economic growth, that is 4% return from the S&P 500 at best over the next 2 decades. Therefore, I have put it here, 4% return, very high risk because at all-time highs, at one of the most expensive markets in the past, you will not be happy with the returns. Also, the links to the detailed videos when I discuss the risk and reward more in depth will be in the description below, stock by stock. And you can also check from top, from the S&P 500 to all the others. Now, Nike and Lululemon is something I discussed 2 days ago. Nike, again, low return, high risk. It's a bet Ekman is doing, but that's what it is, a bet. Let's immediately switch to Schwab, the dividend ETF. If you look at the stock price there, it has been just dividends for the past few years, while the stock market did much better. I have looked a little bit at my intrinsic value template, and at the dividend multiple of 20, 100 divided by 20 is a 5% dividend yield, expected 5% growth rate. I think that might be too exuberant for what's going on with the economies. I get an intrinsic value of 20 for a 10% return. The price is now, what, 28, so you get likely a 7% return, all else equal. However, from a margin of safety, and I just returned from my YouTube holidays, which means I am sharp on value investing, the price should be 50% lower for a margin of safety, 10% expected return. Therefore, I think you will get your 5% of the dividend over the long term, but that's about it when it comes to Schwab. We have discussed Berkshire, I think yesterday in a video, link in the description below. To me, Berkshire is always great. You have the certainty of long-term wealth creation and compounding. However, at these prices, you might have to wait a decade to get some real returns. What do I mean by it? Well, if I look at Berkshire's intrinsic value for a 10% return, I'm at $500 billion. The current market cap is more than $1 trillion, which means that Berkshire is twice the price for the 10% return you might want to expect. But the 4 or 5% long term is something Berkshire will deliver with certainty. And that is then, again, always better than many other opportunities will give you out there. The next one, Amazon. This is very, very interesting. So the stock was pretty high, then we had that issue that was down 30%, and from then we are up almost 40%, 36% now. So when it comes to Amazon, there will always be these longer term cycles, these up cycles, longer term down cycles, and I always like to wait for these temporary issues for these great companies where you can really buy them on the cheap. Because no matter what, 13% growth in sales, everything is growing, net income has been increasing, especially from the accounting standpoint. They are spending $100 billion on capital and growth, which is staggering. And if I look at my valuation, if we take net income of 80 billion, if they would spend less a little bit on capex, it would be there. If I just put 8% growth, 20% terminal rate conservative, we are at 1.2 billion. Don't forget, it was trading just a while ago at those levels. More exuberant valuation, 2 trillion, sorry, 1.2 trillion, 2 trillion, and then really margin of safety is below 1 trillion. So from that perspective, I think 7% return should be expected from Amazon, a little bit high risk on those cycles. So it is here already. It should not do badly in your portfolio, but okay. The thing is that the growth, the everything will never be linear. Recessions, this, that, expectations, everything is expectation. So when the market turns negative, you might want to buy on the cheap. The last time I made a video, Amazon stock was 90. I told you 2x reward. Further risk was 30%, so good for those that bought. Next, Verizon, the dividend payer there, that has more debt than some countries, but the dividend there has been stable. The stock price depends on interest rates. If interest rates go down, the stock price go up. If interest rates go up, the stock price goes down. So people in the market see as a bond a little bit more risky than the government, but stable contract, stable position, and I have put it exactly there, 6% yield. Don't expect real capital appreciation there. 6%, a little bit more risky than the average market risk. Let's say this is the market risk at these prices. Let's say that the average investment risk that one could call, and you have it here. Nothing wrong with it, a little bit too much debt for my taste. I have removed it a little bit towards lower risk and higher risk because of the, let's say, extreme possible situation hitting that debt. Nutrien, fertilizer company, I've started following it here. We are already at 57 from the below 50s, which means I have to move it a little bit lower on the quadrant, bring it, let's say, from 7 to a 6% return with a little bit more risk due to the increase of price. Now, Tencent, here it was in July. Let's see what's happened. Well, the stock over the last year and something more than doubled, because if we look at the latest earnings, things have really exploded from stagnating growth, some growth, not picking traction. Now we are back to double-digit growth. Double-digit growth means higher price-earnings ratios, higher expectations means a boom in the stock price. But if I look at my table, if I put a conservative valuation there, then you see, okay, here 10% growth, 25% terminal multiple, it is justified. However, if you expect a margin of safety, we are far from that. So due to the stock price going higher, I have to move Tencent from this level to a lower and riskier level on the quadrant. Now, Dow Inc., I've put it there as a cyclical, as you can see, likely good return 9-10%, but high risk as it is down on the y-axis. If you look at the stock price, they have tried to do anything to keep the dividend. Now they have cut it already twice, and the consequence is a more than 50% decline in a stock price. If we look at the results a little bit, well, greater financial flexibility, improved profitability, capital allocation approach. When a cyclical enters into trouble, then these are the things that they are discussing. If not, it would be buybacks and growing dividends. But let me just share another thing that I hate from Wall Street. Repurchases 2.3 billion in 2022 with 1 billion in 2021. Look at the stock prices, 2022 and 2021, almost triple where we are now. Of course, now buybacks have vanished because they simply don't have any money. So they are again cutting the dividend. The stock price follows. A dividend cut is never priced in, therefore the stock will most likely crash again on the dividend cut. Post adjustment, we are at the 5%, we have been for long at the 10%, and now that is unfortunately cut. However, when I look at things, at what's going on, they see themselves as a compelling investment. They are managing their assets, selling, getting money wherever they can. However, think of investing Wall Street way. When you're in trouble, you fire sale assets, thus you're not getting good money for it. On the contrary, this is value investing. Berkshire is now waiting to buy great things on the cheap. Berkshire stock is up, Dow is in the toilet. There is equity, but if I look then at goodwill, past acquisitions where they of course overpaid, they're not doing acquisitions now, long-term debt, which means that there is no margin of safety in the equity, because even if you look at the market cap, it could be trading at book value. Therefore, I'll keep it here at 10% return and high risk, because if they return to the potential net income profitability of 4 billion, compare that to the 17 billion market cap, this is still has the potential of a 3x. And if I go to my Peter Lynch video, also link in the description below, you see that there is a stock categorization, 6 categories, and you want to take into account cyclicals. Here is from that video. So when the economy turns or the sector turns good again, that's your 2x, 3x. However, suffer when there is no economic growth, tariffs, whatever is going on. Timing is everything. Watch for inventories and new market entrants. However, you can also wait, and it's easier to predict an upturn than a downturn. You can wait for things to start improving. 3 to 4 bad years followed by 3 to 4 good years. So we are just in year 1 or 2 of the bad, so we can still wait 1 or 2 and then watch it. I personally prefer cyclicals with moats like a copper miner, but there is no recession there. For now, these are no moat commodity producers, chemicals, and therefore, because of the high competition, a little bit lower than expected demand growth, then you have this very, very bad situation. So for now, I haven't invested. It looks interesting. I think it's already a good buy, especially if you diversify across the sector. The sector should eventually pick up in the future, but it's simply not my kind. As a value investor, I need a margin of safety. Now, Kraft Heinz, we have discussed it. Dividend is there. However, the stock is not going anywhere except for that dividend, and perhaps it is because brands are changing. Brands today, you're listening to me, independent researcher somewhere from the world on YouTube. You are not wasting your time with mainstream financial outlets. Everything is changing. Therefore, also these brands are not having the power than those brands, as we discussed with Nike, had 10, 20, 30 years ago. That's the huge situation change. And you also see that into organic net sales negatives, something still growing on expansion in emerging market, but that's not enough to turn ship. And net sales down, they are trying to save things left and right to get to 10% cash flows, etc. However, I see the dividend. I cannot see further on growth, on turnarounds. Therefore, I have to bring it from here to just the dividend and perhaps even seeing cuts, put it on a riskier side, and that is what the valuation gives us. If they don't grow the dividend in the future, someone might take them out at this price. So that is maybe the margin of safety that someone will buy and try to do something or things like that. But that's another story. Alright, Occidental Petroleum, if it is a good buy for Buffett at these levels, it might be also a good buy for you. However, you need to know what to expect, why you're buying, what kind of returns, and what are the key risks. The stock was higher a little bit, has declined, rebounded a little bit as the bad expectations related to oil prices haven't materialized. However, the value creation there is debt repayment. So if you look at the market cap of 46 billion, and if you look at how much debt they repaid, and their plan is to do 5-6 billion a year, that is value creation. As a company repays debt, that's value creation, and that is in the line of 10-12% per year as they are repaying debt. They are still doing that despite lower oil prices on average, so at around 60, 64, they should still be doing 4-5 billion per year, which means that they can keep on repaying debt, which is their current focus. They will also invest in growth, low carbon opportunities, where they get another 1.5 billion of cash flows per year expected. And then when the debt is down, which is 2027 likely, you can expect repurchases and dividend growth. They might also buy out Buffett. However, when you look here, they're already paying a dividend that should be then growing, and therefore, especially if oil prices go higher, you can see it back even perhaps to 100 in the future. So that is a 2x from that reward perspective plus dividends. 2x over the next 5, 6, 7 years, that is the 10% return. However, on the risk side, there is always this issue. If oil prices, for whatever reason, go down a little bit, this can then go to the 30s. It is backed by Berkshire and Buffett, so unlikely risk of crazy shenanigans, bankruptcies, etc. So there is also some downside risk. So a mid-portfolio position should be okay. If it gets better, great. If it goes lower, you can temporarily put it a full portfolio position. When it comes back, bring it back to a mid-portfolio position, and there you also have some rewards plus likely future dividends. To stick with oil companies, we have AKER, BP, and Equinor. The Norwegian, very low cost, high Norwegian taxes on profits, but very profitable with high dividend yields. So if you want a good dividend yield, no matter the oil prices, I think they will pay those dividends 8, 9, 10%, even if oil prices go below 45, which is then again unlikely. So if you want lower risks, Equinor and AKER BP, 10%. There we are. You have these companies that can also be considered a buy here, 9-10% dividend, what is it, 15% Norwegian taxes on withholding on dividends, and there is, let's say, the safer oil play because their production costs are much lower. If oil prices go down, they make a little bit less profit, but they pay much less in taxes, and therefore the cash flows are still there. So very interesting. As always, you can check in the link in the description below my latest detailed videos on these stocks. Then we have in the middle there BHP Group, iron ore, and you can see it was high, then it went lower when the tariff liberation day scare. Now we are back. If we look at free cash flow per share, we are getting at intrinsic value of 50, which is around the stock price, but I might have been a little bit more exuberant here with a terminal multiple of 20 on the free cash flows. They are paying a lot of that into dividends, which is okay, but if I check here, the dividend is just 4%, not 8-9%. Therefore, I might have adjust the payout ratio and then this goes down. The stock is up a little bit because after Liberation Day, iron ore prices have rebounded, but the trend with iron ore is clear due to supply and demand. Therefore, it's expected to go even 70. If there is a recession, it can go to 60. Therefore, I see long-term great assets, so medium risk, short-term in case of a recession, it should be much more risk, but good long-term return. You have the 4% dividend, there is 4% growth likely on inflation, 2% organic growth on the great assets, and that is a 10% long-term return from BHP, 4% growth. So we are there, 9-10%. Nothing wrong. I would prefer it at cyclicals commodities at 15-20% cash flow yields, not 9%, because that average cycle cash flow yields is where usually you can find these cyclicals when people get scared. As we have seen with the Dow Chemical. The difference here is that here you have a moat, you have a very specific position in the global commodity market that Dow Chemical doesn't have. That's the difference there. So I have removed a little bit just to be conservative, lowered a little bit the return because of the dividend, because of the risks, because of the, let's say, situation with iron ore. So lowered a little bit, 6% likely, medium risk because of the long-term quality of the assets. Now, Archer Daniel Midland, it was one of the best buys on the Quadrant, also something that I promoted on this channel significantly in the beginning of the year. Well, the stock is up from 41 to 60. Okay, if we started discussing it as a buy, below 50 as a strong buy. So we are from 50 to 30-40% higher. That means that the dividend is not 5% anymore, it is 3.26. Mathematically, the returns will be lower and the risks are now higher. The business all okay, still low on the return on invested capital than targeted, but the cash flows are there, everything looks stable, okay. Full year outlook is okay, down, this up, but that's standard when it comes to the company. The dividend, they will keep on likely growing the dividend. If you expect 4% dividend yield and intrinsic value, I get to 42, and therefore I want to wait for those cycles and buy more when the outlook is negative. The market has a negative perspective, but it's still food, so it is a stable situation there long term. In exuberant times, we are now priced for 6% growth, 3% dividend, which is not value investing. Margin of safety would be below 40. Maybe we'll see it, maybe not. However, I have to do this. I have to put it on lower return, not more, 10%. Now we are at, let's say, 6% long-term with, let's say, inline market risk, and therefore, unfortunately, I would not buy it. It's still good, but not as good as it was just a few months ago. The next one is Google. So I have had it here at 12%, but highly risky. The risk derives from the business model situation with all those AI. Will Google be able to compete or not? For now, Google is doing great, profitable, everything is growing, nothing, it seems like it isn't impacted by AI, but there is always the question yet. I'm using it less and less also to ask questions. In a few years, you'll be talking to someone more than you will be researching on Google, which means that the key driver, the search engine, might be compromised. Might not, might be. There is also Perplexity and everything from Google, so they are fighting for it, but that is the key risk and reward. However, fear that changes as Google delivers good results. 44, it's still the cheapest of the Magnificent 7, cheapest of the market, cheaper than the market with the 30p ratios. There is still room to grow, and especially if they keep on growing at 40%, 22% net earnings growth, really staggering. They are also hugely investing growth there from the capex, but still good cash flows. So when you look at that, EPS growing faster, especially than I expected here, if they keep on growing at 10% with a good terminal multiple, then the price is still justified. However, not margin of safety situation and just another growth stock. Because of the issues, because of the stock price going higher, I have to remove it from here, bring it to here. It's 50% up and everything looks great now. It's better to buy those things when things don't look as good. ASML, the stock is, let's say, flat since we started discussing it. The P ratio is 23, but the business is still there, growing 15% margin there. So if they grow 14 and 10% on their baked in things, I think that the intrinsic value is much lower than the current price. More exuberant growth, better valuation. We are close to the current price. But when it comes to ASML, I always looked at, okay, can I make money on it? Yes, the stock price in 10 years will likely be double, 7% per year, okay. Maybe you can also play on that stock price cyclicality, the ups and downs that it has, 1000, then it goes to 500, and depending on the sentiment there, it's far from a margin of safety level. However, also the worst case scenario, you don't make any money in 10 years, you make okay money and you make good money there. So that is the risk and reward. You can check my videos discussing it. I will likely close the coverage because it's not something that I will invest. I have enjoyed following it, I have enjoyed learning about it, but I know it's a hot topic, but it's far from being a value investment. So because of that, I have put it here as a more margin of safety, putting it away from, let's say, a buy perspective to not get people confused. Greenbrick Partners, David Einhorn's business and business model. And if you look at here, market cap is 3 billion. They are doing 300, 400 million in value creation. They are buying land. What was it? Austin, I think. So they are continually compounding. P ratio of 8, saying that all the stock market is expensive. They are investing into land. So if you're looking for land inflation protection, if demand keeps on going, that should be an interesting solution for some value investment portfolios. So it remains here. They do the 12-13% value creation. It is a little bit risky because it is still real estate and you never know with those markets. Petrobras, Valaris, we discussed it a few months ago. It is up since the bottom, but that is the volatility on when things are improving. Here are the still potential 3x, possibly also no risk, we'll just touch it a little bit. And if you look, they have made some money, they have made cash flows, operating activities, free cash flow, market cap is, what was it, 3 billion. They will make likely 300, so that is 10% free cash flow yield. They have sold the jackup for 108 million. They have 20 something of these jackups, but the most important are the drill ships. So also from that asset value perspective, you have a margin of safety that it is unlikely it will go lower, and then when the next oil cycle comes, when demand booms, then you can sell this on that cyclical situation. That is what Petrobras is waiting, as we have discussed. So the stock is up, but I still keep it here on a 13% return, higher risk depending on oil prices, but very, very interesting Petrobras situation. So we are shamelessly cloning the shameless cloner. Similarly, another idea, Warrior Met Coal, the stock is up 40% because coal prices, met coal prices went from lower, unsustainable lowers to 200, a little bit higher, which means cash flows, which means Warrior Met Coal will be possible to complete their production of low cost, the new, what was it, Blue Creek or something like that. So still, on a long-term basis, they will be able to do everything. No debt, looks okay. Still, that bet looks okay for the future. However, I have put it here because the price is simply 40% higher. There is still potential, but there is also a little bit more risk, especially if we run into coal issues. Petrolero Brasileiro, the stock is going down. I think I made a valuation mistake, expecting a higher dividend yield. They have adjusted it, but the cash flows are there, positive, but not at 75. We are going closer to 60, which means also their cash flows are impacted, especially the free cash flow, which doesn't allow for that high of dividends. However, I have made a mistake here, 1.75, I think the dividend is 1, which then changes the valuation. And you see here, with no growth in dividends, very conservative, the intrinsic value is 10, where it is. If the dividend grows, we are at 16 for a good return, plus the yearly 10% dividends, don't keep in mind, and then the stock price, in case of disaster, it will go lower to 4 or 5, government things like that. So because of the dividend change, I have put it not from 13, I have put it to 10% high risk here. No risk, 10% here. Of course, if oil is at 80, these guys will stay flat, these guys will boom in stock price. But okay, that is the situation. Okay, so where are the 5 buys? Well, as you have stuck to here, as a reward, I'll share 2 of the things that I really own. I still think those are very interesting buy, especially one is a pure value investment. You can retire on buy. Let's start with adding Alibaba on the Quadrant. So Alibaba hasn't been discussed on YouTube. I'll discuss it now and then I'll shut up again for a year or 2. But we are now at interesting levels. We have made good money on the research platform, playing that cycle and exposure through portfolios. If you like these 2 investments that I'll discuss, check my research platform. We have even better risk and reward value investments, and this is the essence of what I do. So let's look at the portfolio. You can read a little bit. We have done the 14-15% over the last 7 years, and I've just started making these short-term, let's say, summaries, investment summaries, teases that I hope you will enjoy. So let me just quick touch on Alibaba. The stock is up because now it is becoming an AI, but it's still a leading Asian cloud company, 1 billion e-commerce customers, growing in Asia, AI growth opportunity as discussed by the CEO. They have, again, as Tencent, started to going on back to growth, 10% growth, and if they keep on growing 10% for the next few quarters, you can expect a P ratio of 20 on the current situation. Therefore, there is still room for 50%, 100% growth. And if you look at what they have been doing, there was this period of stagnation here, but they are still growing, they are still investing, they are still the leaders on AI there in China, and therefore something very interesting. However, from a pure free cash flow perspective, if I look at my conservative valuations, I get to an intrinsic value of 90. So, of course, now at 134, it's a different buy than it was at 70. However, and I have bought significantly down, then lowered the position, but I still have 5% of the model portfolio in Alibaba, as I want to see if this AI growth, perhaps it goes to 200, 200 something, if it works. Of course, the P ratio and everything is not as good as it was from that perspective. China slowdown, China risks, things like that, 4% of the model portfolio. So in case of AI exuberance, I can gain 2%. In case Alibaba compounds the ecosystem, I can compound long term. If not, I can then just lose the 2% there on the portfolio. So it's a following, not always selling, just waiting for other opportunities. I'll assess the complete model portfolio during this month, still have some updates to do, summaries on these covered stocks. So if you join now, you'll get a great opportunity to see where we are. So Alibaba, if I would have to put it on the quadrant here, I would put it here, so still likely 9% return from medium risk, the best buys of what we have discussed. But let me also discuss Amsterdam Commodities, which from that perspective I think gives you 10% food, defensive, everything good with low risk. And these are the value investments that I'm looking at my research platform. There are a few even better ones. So feel free to check it, 21-day money back guarantee. Check if value investing, as I'll present now with Amsterdam Commodities, is something that you think could create long-term value from a wealth compounding value investment perspective, where we focus on lowering risk and when we focus on certain returns. Let's discuss Amsterdam Commodities. So just going to the next summary here, and it's a business, it's a niche, it's spices, edible seeds, organic ingredients. That is the moat of the business. It's very hard to replicate their sourcing, 100 years of history and things like that. And they are doing these acquisitions where they're implementing new businesses, smaller businesses into their system. That has done greatly over the past years. Look at the growth rate as they do an acquisition, then they increase the profitability. And it has been 8% earnings growth over these long-term cycles. They are growing revenues. Their target is to reach 2 billion by 2030. So that's 50% growth almost there. There is a 5% dividend yield. Also with 100 million in net profit on at 2 billion of sales. That is a P ratio of 6, which means likely be 12 in the future. So that's a 2x there. Plus the 6% dividend we are talking already. If I put that into a valuation perspective with dividend analysis, the intrinsic value is 23, and therefore compelling opportunity for long-term dividend and growth investors, attractive valuation, growth potential, everything looks good, but it is overlooked because it is, yes, small European mid-cap, but it is food, it is dollars, it is spices. So I have been following the company since 2015, and now I really like it. The risk is there always can be shocks on food, some cocoa prices going up and down, so that is what created even better buying opportunities. That has been solved, so the stock price jump here is justified. And then when it comes to these businesses, for example, another smaller business in the Netherlands, JD Peets, we discussed it in this video 7 months ago. The P ratio was 15, the market cap was 8 billion. And now the market cap is 15 because there was a takeover, the dividend yield went from 4.5 to 2.3, and I think that all these small companies will eventually be sold. So at some point you will have that 30-40% jump and you get a 6% yield while you are waiting. Very interesting situation. This is the kind of things I like. If I look at here, some companies I will not be following, so I don't have much to add value. Of those companies that we discussed, I think I will clean some out, like Nike, Lululemon, Tencent, Kraft Heinz, things like that, and we'll stick to these companies that are here. Oh, I left ASML. Okay, we'll follow these, and now a new season of research is coming for me, so a lot of new stocks, things will rotate, and then over time we'll build an even better intrinsic value table, things to follow. So if you enjoy this research-based fundamental value investment style, subscribe to this channel for support, check my research platform, check my free value investing course where I update monthly an email for the Quadrant, and I'll see you in the next video.